Hello folks, Steve Lynch here with Discover Options here at Option View. Welcome to this presentation of 3 different market timing reports for advanced options traders. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. All 3 reports today address the S&P 500 in the context of its current market condition. So let's go take a look at that. This is for July 6th on Friday, getting ready for Monday the 9th. And as you can see here, the S&Ps have experienced 2 consecutive upswing bars. This is the first dimension that we look at is price action. 2 consecutive days of higher highs and higher lows. This is occurring all above the 50-day simple moving average. So altogether we are in an uptrend. In terms of the stochastic situation, the stochastic is trending upward above its 3-day percent D between 30 and 70. Okay, all 3 dimensions combined create a market condition that has occurred roughly 136 times since January of 2000. Now with that market condition defined, let's go take a look at the 3 different reports. The Condor butterfly timing report answers the question, is now a good time to start a butterfly or condor campaign? And so here's how we would answer. Well, since Jan of 2000, we've had 4,665 daily closes of the S&P 500. And of those, 65% have been favorable bars for implementing these kinds of strategies. Favorable bars for selling options premium, where the subsequent 21 bar movement was less than what was being implied by the option prices. Now, also during that time, as I mentioned, we've had 136 times where this market condition has been duplicated in the past. Of those 136, 66.2% of the bars were favorable for selling premium in this fashion. And so that's technically a selling edge, a small one of just 1.2%. Okay, so just slightly better than benchmark in that regard. Statistically, it's more likely than usual that our current market condition will end up being a favorable one for market neutral option premium selling. All right, now let's go to the next report, the bull put spread timing report. This is for those that like to sell puts in the indexes. In the index, S&Ps, standard deviation out of the money, roughly 30 days out, either through naked puts, bull put spreads, or hedged bull put spreads. That's what we teach in our Discover Options mentoring program. So let's explore this. So as I mentioned, we've had 4,665 closes of the SPX. Now of those, 83% of the time, the market it ends up being a favorable bar for selling puts like this, where the actual 21 bar downside movement, was less than what was being implied by the option prices. And we look at the skew adjusted VIX to get us that implied move to the downside. Okay, so 83% of the time, you can flip a coin and you're going to land on a bar that you don't see the market subsequently move down that standard deviation to the downside. Now, of the 136 occurrences, well, 77.9% of the bars were favorable. So that's not as much as the benchmark. Okay, so this implies a put premium selling edge of really it's negative 5.1%. So statistically, it's more likely than usual that our current market condition will end up being an unfavorable one for selling out of the money put premium in that fashion. So we have a little bit of a mixed bag here. And so to get to the bottom of this, let's go to the market likelihood report, which will bring some clarity here. What we like to do is look at the rate of change that has occurred. And so we looked at those 4,669 in this case. We're looking at the S&Ps going back to Jan of 2000, and on average, you have a 5-day rate of change of 0.1%. We've had a bullish market since Jan of 2000. We've had some bearish seasons. All in all, the market's gone up. An average of every 5 days, it goes up 0.1%. Every 2 weeks, it goes up, or 10 bars, it goes up 0.5%. And every 3 weeks, or 15 bars, it goes up 0.29%. That's the average rate of change during those time frames since Jan of 2000. Now, let's go and look at our 136 occurrences. On average, we've had the market move down for those 136, an average of every 5 days of 0.16% to the downside. Okay, now that's a difference of 0.26%. Instead of going up 0.1, it goes down 0.16. How much is that difference? Is that a significant difference of 0.26 to the downside? Well, we derive that through a z-score. In statistics, we call it a z-score. We take that difference and divide it by the standard deviation for that time frame, and we discover that that difference to the downside is barely even a third of a standard deviation to the downside. Okay, for it to be of significance, we'd look for something closer to a full standard deviation to the downside to really sit up and take notice. Here, it's not barely even a third of a standard deviation. In terms of the 2-week z-score, it's at 0.39 to the downside, and the 3-week z-score is at 0.42 to the downside. Again, approaching half a standard deviation, but again, just take note that on average, it's to the downside. Now, to drill down further and get clarity, we need to divide these 136 occurrences up by those occurrences where Friday's high was exceeded, or the previous day's high was exceeded to the upside, and those occurrences where the previous bar's low was exceeded to the downside. We see huge differences here. So if on Monday, price ascends above the high of Friday, you have a whole set of likelihoods different from if the market were to go down below Friday's low. So let's dive in and explore that. Of the 90 occurrences where the market went above Friday's high in this case, we see that the 5-day average rate of change was at 0.28, or a z-score of about a fifth of a standard deviation to the upside. The other z-scores are around a tenth of a standard deviation, nothing to really write home about. But look at the downside. If the market takes a real dive to the downside and exceeds Friday's low, and that'll be a big move, well, then you see the z-scores now to the downside of pretty much a full standard deviation to the downside there. So that'll be a situation to really sit up and take notice. If the, okay, so I already said that. Now, let's take a look at realized volatility. On average, okay, you can see here that the market has roughly a realized volatility level annualized of 15 to 16%. That's the realized or historical volatility. Now, for our market condition, we're somewhere in the 13 to 14 range. It's a bit below the benchmark of average realized volatility. And when we come down here and look at where the VIX is, we see we're right there in the 13s. The short-term VIX annualized, the 9-day VIX is at 11.49, so quite a bit below. Okay, so and you can see that the VIX is kind of a little bit below, especially if the market goes to the downside. We have a realized volatility now much higher than what the VIX is set at currently. Okay, so that kind of explains then the negative market edge that we saw in terms of the bull put spread timing report. Okay, especially on the downside move. All right, I hope this has been helpful information. Thanks so much for tuning in. We'll be back next week. Again, I'm Steve Lentz with Discover Options. Thanks for joining us today. Bye-bye.